Robert Prior-Wandesforde. He is head of India and Southeast Asia economics at Credit Suisse there in Singapore. Robert, thank you very much indeed for joining us. Why is it been so difficult for India to control inflation over the years?
Well, I think above all else, the policymakers have kept policy too loose for too long, and what that has led to is India continually bumping up against these capacity constraints, both in labour and product markets, to such an extent now that you're running out of skilled labour. Companies are very short of capacity. Input costs are rising, and in a nutshell, really, India faces some sort of mini wage price spiral. Those inflation expectations have become entrenched at a very high level. To tackle them, you need pretty drastic action.
Yeah, so is the medicine just wrong? I mean, we had, that surprise 50 basis point move. None of the economists we talked to had expected it. Now, is that the right way of tackling this, or should they be using other monetary policy tools?
Well, ideally, I mean, they should be tackling it through the supply side. In other words, improving the productive potential of the economy. Now, in practice, that clearly hasn't happened. You've still got huge and obvious constraints to growth, not least infrastructure, of course. So that, in effect, what that's led to is that the Reserve Bank has had no choice but to tackle demand. And the best way of doing that, and the best way of breaking this wage price spiral, is to shock. Now, as you rightly say, they have shocked. In fact, 2 of the last 3 meetings, they've delivered a bigger rate rise than everybody had expected. And unfortunately, that is probably the only way, realistically, that India can tackle these problems. But that means India is going to suffer, in my view, a much bigger growth slowdown than everybody's expecting.
Robert, they target something called wholesale price inflation. Now, most people look at consumer price inflation. Why do they look at WPI, and how accurate a measure of price rises is it?
Yeah, I mean, there's a very good question. I think India is probably the only country I'm aware of where the central bank focuses more on the wholesale prices than the consumer prices. It's largely because wholesale prices, A, are more timely than consumer prices, and as far as consumer prices are concerned, there are 4 different measures, all of which are based on a consumer survey that is massively out of date and therefore gives far too much weight to food. Trouble is with the WPI is that it's highly dependent on international commodity prices, and in that sense, you could argue that China perhaps has a bigger role on India's WPI than India does. So the central bank has a huge problem here. They are flying blind, most of the time, and really I think they should be looking at a much broader range of indicators, anecdotal evidence, survey evidence, and so on. But right now, the central bank is made it absolutely clear that it's all about the WPI, and that, in a sense, I think raises risks, or greater risks, of policy mistakes.
Right. So, when do they actually, calm things down? And, at what price growth? I mean, that's what we've been talking about. Of course, you've got this trade-off. I mean, it goes to basic Keynesian economics, essentially.
Yes, I mean, what the central bank has said, unusually for a central bank in Asia, is that they are explicitly saying that they are prepared to sacrifice some growth in the short term to ensure medium-term sustainability. I think that's right, but I also think the central bank is going to be, and the market is going to be, surprised by the extent to which growth actually responds. It seems to me that the RBI is underestimating the time it takes for interest rates to impact the economy. I think it takes 12 to 18 months, and therefore we're really only at the very early stages of seeing the very first effects of the tightening. And yet they seem to be surprised that there's not a broad-based downturn in growth. So as time goes on, as I say, I think they could be surprised by the scale of the downturn, and I suspect eventually, and eventually may not be that far away, I mean, maybe fiscal Q1 of next year, the bank will be actually cutting interest rates.
Robert, so what you're saying is that they're behind the curve. That's one part of my question. But the other part will be, well, if they spent more money on infrastructure, roads, etc., made food supply that much easier to get into city centres, a lot of these problems may go away.
That's absolutely right, but that is not going to take that is going to take quite a long time to do. I mean, it's a problem that's been apparent in India for decades, and yet nothing meaningful has really happened. I mean, let's give one example. I mean, roughly 40% of food rots on the road. Now, that is not a particularly helpful situation when you're talking about food price inflation, and the population is growing dramatically. It's going to expand by 300 million, basically the size of the US over the next 20 years. Agricultural productivity is going to have to boom to cope with this. So I think we're in for, unfortunately, a long period of sticky, high inflation, not least in food, but in the economy as a whole. We're going to get ups and downs, and I think with this growth slowdown that will have some taming effect on inflation. But there's a big structural problem there, and it's a problem that will limit the growth of the economy. India is not as bulletproof, Indian growth is not as bulletproof as everybody seems to think it is.
Robert, thanks a lot for that. Robert Prior-Wandesforde there joining us from Singapore, just taking a look at what we have with the inflationary environment there in India.